This is a warning. If you are looking to invest in property in Australia, then you need to listen to this. So I'm James, and this is Money Media, and I want to talk to a point that absolutely nobody is talking about right now. And it's got to do with the economics of Australia and where we're trending. And so this is a very important video if you are considering investing in real estate in Australia in the short term. So there are three main forces pushing against housing prices right now, and I'm going to go into each three. So the first market force I'm going to go into is supply. And so a large part of the reason why property has been so expensive in Australia and has been increasing so fast recently is because we have a constricted supply. We're not building houses fast enough for how fast our population is growing. And so that is putting massive pressure on housing prices to go up. There's a few structural changes that are coming within Australia that will affect the supply. And so I want to talk to these. The first structural change that is happening in Australia, and it's actually beginning in a little over 4 weeks now, is that taxation on superannuation for assets that are valued at above $3 million. So what this structural change is going to do is it is going to encourage those with self-managed super funds who have lots of wealth tied up in residential real estate in Australia. It is going to encourage those people to sell off their real estate to reduce their tax burden in the superannuation. What that is going to do is increase supply quite significantly, actually. It's an estimated around 65,000 residential properties, not including commercial, 65,000 residential properties currently held up in superannuation funds could be released directly to the market. The second factor affecting the supply is we have a top-heavy population. We have an aging population who largely own real estate because they were brought up being told that housing is a very safe form of investment. So when this aging population becomes deceased, that property has to transfer somewhere. What a lot of people aren't talking about is a big percentage of these properties that are owned by these aging populations. A lot of them don't have descendants to pass their property down to. When that happens, the property goes to the ownership of the state, and the state will not be hanging on to these properties, they'll be selling them. So that's the second point. And the third point about supply is that the government has already committed to increasing housing supply by 2030 of 1 million dwellings. Now, I'm assuming here that this is an additional 1 million dwellings on top of the supply that we will see added from the taxation of superannuation and from the handing down of properties from deceased estates to the state. That's a lot of property hitting the market within the next 5 or 10 years. And so that's the supply side. The demand side is that our Australian population is reducing. We're having less children in Australia. We're not having enough children to keep up with our aging and deceased population. So our replacement rate is not there. And that's the demand side. There's a third side that I want to talk about, which I'm a little bit concerned of, if I'm being honest, and that's leverage. So a quick example of leverage is this. If I had $10,000 and I was to buy shares in a company for $10,000, that's 10 grand. If that company went bust and shares went to zero, I would lose 10 grand. With leverage, which is how people buy properties in Australia for the most part, if I was to buy a property for $100,000 in Australia and I was to use a 10% deposit, meaning I would have that same $10,000, then I would borrow the remaining $90,000 for this property. If the property loses 10% of its value, and so if the value goes from $100,000 to $90,000, I then lose my $10,000. Sounds simple enough. Now, if we have a major addition of properties to a market that increases supply, that reduces the value of a property. So let's say that $100,000 property that we have doesn't fall to 90,000. Let's say it falls to $50,000. Well, not only have we lost our $10,000, but assuming we need to sell the property for whatever reason, we now owe the bank $40,000. So we've lost 50 grand. From $10,000, we've lost $50,000. That's leverage. Leverage is a magnifying glass, and it magnifies your net position. So in Australia, everything's been rosy for a long time now because property has continued to go up. So everybody will encourage you to use leverage, i.e. a mortgage, to buy property. That's all well and good when properties go up. When properties go down, things get really concerning. And this is why I wanted to create this real warning to people who are looking at investing in property in Australia in the short to mid-term. I think there's a real risk. I think there's a massive risk, and it's due to all the structural changes that are happening. And so if you are looking at property, you need to be wary and you need to do your research, because you do not want to end up with an upside down mortgage. I can tell you that.